Most people avoid buying property because they are afraid of paying interest. They don't like owing money, and they worry it's going to be a bad financial move. But after watching how homeowners actually progress over time, I realized something uncomfortable. The people who fear loans the most often give up one of the safest advantages in property. Not because loans are risky, but because it's misunderstood. If that's how you feel, you're not wrong for being cautious, because buying a property is usually the biggest financial decision people make, and nobody wants to regret it later. The problem isn't that people are too conservative, it's that many people are worrying about the wrong part of the decision. Over the years, after seeing how different homeowners progress, especially HDB upgraders, a very clear pattern shows up. The issue is almost never about how expensive the mortgage interest really is. It's always about how mortgage interest is being misunderstood and not used properly or avoided altogether. Most people see the bank as the enemy when buying property. They worry about interest, they don't like to owe money. But what if I told you that the bank is actually one of the best and most misunderstood partners you'll ever have? This mindset shift completely changed how I looked at property investing. And if you get this wrong, you may totally miss one of the safest advantages available to you. In this video, I want to talk about something many property buyers fear the most, which is mortgage interest. What I hope to do is to help you see it for what it really is and why fearing it without understanding it may cost you more in the long run. Let me start with a simple idea. In most business partnerships, for example, if you want to open a cafe, you and your business partner comes up with, example, 200K as capital. So whatever profit you earn will be distributed in proportion to the share of capital you put in, right? So for example, you put in 100K, so that's 50% of the capital. And if the cafe makes a profit of 80,000, for example, your share will be 50%, which will be 40,000, correct? But this is very different when you buy a property. Buying a property is also a partnership, just that you're in partnership with a bank. But it's one of the most unequal partnerships you'll ever be in. And the good news is it's unequal in your favor. Because when you buy a property, you put in 25%, the bank puts in 75%, but you control 100% of the asset. The bank doesn't share in your upside. They don't care if your property goes up by 500%. They don't get excited about appreciation. They only collect interest. That's it. But despite this, many people fear the bank. Myth number one is, I don't like owing money. The idea of owing money makes me uneasy. If I can pay it off, why should I owe anyone money? But this is purely emotional and does not make financial sense. In most areas of our life, sure, owing money is bad. But property is different because it's a productive asset. It's not consumption. You're not borrowing it to spend. You are borrowing to control something bigger than your capital. Myth number two, interest is a waste of money. People say, why should I pay interest to the bank? But interest is not a punishment, nor is it a fine. It's the fee you pay to use someone else's money. And if someone offered to be the major shareholder and put in 75% of the money and lets you benefit from 100% of the profits and only charge the interest, most people will take the deal. And that's exactly what a mortgage is. So myth number three is there's opportunity cost. I could have invested the money elsewhere. Some people say that, well, if I put money in the property, then I pay interest, and I also cannot use this money to invest in other things like the S&P 500. That's true. Our capital is finite. But property isn't just about returns. It's about having stability, leverage, force discipline, and peace of mind. Because it won't ever go to zero, no matter what crisis occurs. Different tools serve different purposes, and these are some qualities that only property can give you. So let me illustrate with a simple example of how paying interest gives you more than just the profit you thought you will make from the sale. So for example, if you were to buy a property at $1 million and it's at 1.3 million 10 years later, why 1.3 million? This is because according to the property price index, properties in Singapore appreciate about 4% every year. But let's be a bit more conservative here and only say that it appreciates by 3% every year. So in 10 years, this property will probably appreciate by 30%, which is 1.3 million. So you think you will just walk away with 300,000 profit, but of course don't know how much you would have paid for interest, right? But this is not what happens because you will take back a lot more. And here is where the magic of taking loans happen. So let me illustrate here. The assumptions are as follows. You are 40 years old and your income of 10K qualifies you to buy a property that costs $1 million. The down payment is 250K, which will be paid in cash. Normally you can use CPF to pay for this part of the down payment, but to make things easier to understand, we will just assume that this 250K down payment is made in cash. So the mortgage loan interest is averagely 2.5% throughout the 10 years. And the loan tenure is 25 years. So let's look at the table. So when we start out, the balance is 750,000. This is what we owe the bank. Okay, so we make our monthly installment of $3,364. And this is made up of two components, the principal sum and the interest. So the bank is very smart. When we make our payment, they already dock off their fee. Okay, fair enough. So this is interest, which we will go to the bank and we will never see again. Okay, but this principal is what is important to us because this reduces our loan balance every month. So every time we pay this 3,003 installment, our loan reduces by the principal sum, which is this 1,008. So every time you pay, it reduces. So you can see by the time April comes along, your outstanding loan is only 742,000 and not the original 750,000. Okay, so this principal is actually a form of compulsory forced savings that is accumulating a lot of equity for us while we are holding this property. So if we hold the property until 2035 for the next 10 years, so this is what happens, okay? We would have accumulated all this equity in our account. And we will be able to realize this when we sell the property. And what happens to our balance? Our balance would have reduced from 750,000 to 504,000. So now let's look at our sales proceeds after 10 years, after we sell the property at 1.3 million, okay? So we have to less off our outstanding loan of 504,000. So our total sales proceeds will be 1,300,000 minus 504,000, which will give us 796,000. Okay, so what is the cost of this investment? The cost of this investment is about $363,000, and this includes the down payment, and the detailed breakdown will be below. So this investment doubled in 10 years without needing the property price to double. So effectively, it means that you take out 363,000, and then 10 years later, you get back this amount, 796,000. I don't know about you, but I think that this is a very good investment. So let's look at the ROI. The return on investment is calculated like that. Okay, the total investment cost is 363,000. The calculation is the rate of return equals to the gain that we get from this investment divided by the cost of the investment times 100%. So the ROI here is 432,900. How I got this number is I take the sales proceeds, 796,000 less 363,000. So that's how I get the gain. So we take the gain divided by the original investment of 363,000 times by 100%, and we get 119% over 10 years, which is not bad at all. So if we were to break it down, the simple will be 12% per year. Okay, so now let's take a look at the breakdown of the cost of investment. The down payment is 250,000, and then the buyer's stamp duties amounts to 24,600, and also the agent's commission for procuring the tenant for 10 years is about 17,500. And then the property tax for 10 years is about 35,000. And the maintenance charges, the MCSD, that every month you pay about $300. So estimated at about 3,600 a year. So if you pay that for 10 years, it will be about 36,000. So all in all, the total cost of holding this investment is $363,100. From the example, we can see that interest is not dangerous and definitely not a waste of money. It is a necessary business expense to allow us to own this asset and keep more than just the profits after it appreciates over time. So if you look at mortgage interest from this point of view, you probably will see that it's not scary at all. And you may even see it as a friend that can help you achieve your long-term financial goals. So talking about long-term financial goals, if you're wondering what is the long-term property plan you can have for yourself to build a $4.3 million retirement nest egg, you can watch the video here or here.